Debentures or bonds? Which one is safer? Which one should investors choose? If you have ever been confused between these two debt instruments, this video will help you to understand their similarities and differences clearly. I'm Dr. Bharati Sunil from Finance and Accounting Academy channel. What is debenture? A debenture is an unsecured loan which is offered by a company only. Only companies can offer debentures. It's a debt instrument where a company is promising to the debenture holder to pay interest and also return principal amount on maturity date. This debenture is without any collateral and asset backing. Example of debentures are convertible debentures, non-convertible debentures. Then bond. What is bond? A bond is a secure loan which is offered by a company, government or any organization. In simple words, it's like an IOU note where the issuer of the bond is promising to pay regular interest. This interest rate is called what? Coupon rate. And also the issuer of bond is promising to pay principal money on a specific date. That specific date is called what? Maturity date. So you can see various bonds like Sardar Sarovar bond, government bonds, RBI bonds. In this slide you can see similarities of debentures and bonds and also differences between debentures and bonds. First we will see similarities. Debentures and bonds both are called what? Debt instruments, and they provide fixed interest to the holder of these instruments. And these two instruments are having a specific maturity period, and both debentures and bonds are less risky than equity shares. Both debentures and bonds holders will get their principal repaid on the maturity date. And both these instruments are traded in financial markets. Debentures and bonds. These both will help our nations to raise long-term funds. So these are all similarities. Now we'll see what are the differences. If you see both debentures and bonds in security aspect, debentures are usually unsecured when compared with bonds because bonds are secured by backup of securities. Issuer. Who issues debentures? Only companies can issue debentures, but bonds can be issued by government and companies. And risk. Compared to bonds, debentures are having higher risk because of non-backup of securities. But if you see bonds are having lower risk compared to debentures. Next, investors' confidence. Investors will invest in debentures only based on issuers' creditworthiness. But if you take bond, it depends on security backing and issuer strength. Next, investor type. So who will invest in debenture? Conservative investors will choose debentures and risk tolerant investors will choose bonds. Interest rate aspect. Debentures usually offers slightly higher interest because they are having higher risk compared to bonds. But if you see bonds generally offers moderate interest rates because the risk aspect is lower. Next, popularity. Debentures are more common in corporate financing, and bonds are widely used by governments and large organizations for their funding purpose. Asset backing. Generally no specific collateral in case of debentures, but if you see bonds, these are often backed by assets or government assurance. What we can conclude here, both debentures and bonds are fixed income investment instruments. But if you compare bonds with debentures, bonds are offering greater security when compared to debentures. That is why on debentures we'll get higher returns because of higher risk. Here you see quick memory tip. Usually debentures are without security, but Often bonds are offered with better security. Now you know the differences and similarities of bonds and debentures. While both offer fixed income opportunities, their security and risk characteristics vary. Always evaluate your investment objectives before making any decision. So keep learning and keep investing wisely. Follow Finance and Accounting Academy channel for more finance and investment concepts.